So I've been conditioned to ignore this situation. I wake up this morning, I want to ignore the situation. Can I ignore the latest situation in the Middle East?
And no, absolutely not. I mean, this is a geopolitical crisis that just won't go away, won't end. The ceasefire, according to the president, is over, and he's clearly in a position to know and in a position to end it. So we're back to square one in some ways, back to where we were in March. I think both sides are testing one another. I think the president is demonstrating to the Iranians that while they may have obviously a significant impact on flows through the strait, he can shut off their oil to the rest of the world. The unsettling development here, I think, is it may very well be that Iran is basically out of control, that the Revolutionary Guard is not going along with whoever is quote unquote on the moderate side. Moderate being that they'd like the ceasefire to continue and they'd like to come up with some sort of agreement. But the president made it pretty clear that it's very frustrating, if not impossible, to negotiate with the other side. And so clearly we can't ignore this.
At this point, Ed, it is sort of surprising, as John was mentioning, that oil prices aren't even higher if the truce really is over. Though the pace of increase is pretty notable. The two-day increase for both Brent and WTI is the most since at least April. And you see just sort of this surge upward. Is there a trigger point, either in the pace of increase or the level, that could make you rethink even the broadening out trade in U.S. equities?
Lisa, the honest answer is I don't know. Nobody knows for sure. So we are all watching the price action in the marketplace, particularly in the oil market. And I think what we're seeing is we're being reminded constantly here that there was a bear market in oil before the war started at the end of February. The bear market actually started when Russia invaded Ukraine. We had a big spike there, and ever since then we've been on a significant downtrend until this war started. So that kind of, and it certainly, everybody was surprised by how quickly the price of oil came down. And I think that just reflects that over in China, they really adopted electric vehicles. And on top of that, their economy is really very weak. And on top of all that, the United States has looked the other way as the Russians have been selling more oil to China and India and other countries. And meanwhile, we've been exporting a lot of oil to Japan and South Korea. So put it all together, and the underlying fundamentals for oil are actually bearish, but they're certainly not bearish in the short term here with the end of the ceasefire.
The volatility that we're seeing, Ed, though, just highlights how much inflationary pressures are coming from myriad places and seem to be persistent, even when you want to say, look, there's potentially a glut because of all of these release valves that you talked about. At what point do you think that this market is underpricing the risk of inflation running a bit hotter, putting pressure, yes, on the Fed, but potentially pressuring certain profit margins for companies that are facing a pretty wearied consumer?
Well, before the June meeting of the FOMC, we thought that the Fed was going to pivot fairly significantly from an easing stance back in April to a tightening stance in June, and that's exactly what happened. The big surprise to me was that Kevin Warsh turned out to be among the hawks, because he had, when he interviewed for the job, he certainly sounded dovish. Now the Fed seems to be pretty much all aligned with the idea that price stability is much more important than the labor market. Labor market seems to be stable, but you know, all bets could be off here depending on what happens with the Middle East. You know, the consumer has been doing just great, but if we get another spike in gasoline prices, there may be some kind of geopolitical fatigue. And meanwhile, the market has run into AI fatigue, and just the, you know, as I saw in your brief cuts for all the strategists that you had interviewed recently, everybody was talking about rotation. I was talking about rotation out of the AI trade into companies that we know something about, and we know their future more than we do the AI companies. And that was the Dow Jones, that was the Russell 2000. But now we're all back to, as I said, square one in some ways with regards to the Middle East, and that's become the main focus. And you're right. Inflation concerns are back in play, and as a result of that, the Fed is back in play. Not only is the Fed pivoted to tightening, but they may actually have to tighten.
This is the three-punch combination right now to sentiment, Ed. It's not just the situation in energy, to your point.
Correct.
It's how you fold that into the outlook for interest rates. And the third point is this rotation, quite vicious rotation away from the high flyers in this equity market right now. Lisa Shallard of Morgan Stanley was pretty scathing in the last 24 hours. She said, while many investors are waiting for AI capex to actually slow before reducing semiconductor exposure, given what is implied about the sustainability of future growth, we're taking profits now. Ed, you were there too, and I just want an updated thought from you about where that chip trade stands now, given the 16% move we've had just in a few weeks.
Yeah, well, clearly we did have a tremendous rally in the semiconductors, and that, of course, led the way up for the stock market. But the fact of the matter is, it's not a FOMO melt-up, it's been a FEMO melt-up. FOMO means fear of missing out, which typically leads to very elevated valuation multiples, which basically is a valuation-led melt-up. This has been an earnings-led melt-up, and I'd rather have an earnings-led melt-up. I think there's less downside than there is in a FOMO melt-up, and I think it presents more of a opportunity in the market, because the fact of the matter is earnings have really justified the rally in semiconductors, and it's not just expectations, but it's expectations based on actual reality. So I would view this sell-off more as an opportunity than a reason to panic. But right now we're seeing not so much panic, just massive profit taking because there have been massive profits.
So, Ed, you went there. When would you start buying these chip names that have been beaten up in just a few weeks?
Well, I think we're getting pretty close, because these things move. They don't kind of do things in a leisure fashion. They go up very quickly. They go down very quickly. And so I think there's an opportunity starting right now, but I say that with some hesitation, given that I don't really know, nobody really knows how this latest end of the ceasefire plays out. And so the war is not over is the bottom line here, and the stock market is working on discounting that idea.